Hello, good morning. Thank you very much and very happy to join you. My apologies for not joining in person. I'm currently in Dubai, so it's actually a good evening. A big thanks to the IAIS for inviting the World Bank to give today's keynote, and very much thanks also to the National Association of Insurance Commissioners for hosting the event. So as I'm sure you know, the World Bank Group is one of the world's largest source of funding and knowledge for developing countries. And we are committed to reducing poverty, increasing shared prosperity, and promoting sustainable development. And in that context, insurance plays really a critical role in supporting the bank's mission. On the one hand, it helps addressing poverty by protecting the poor against vulnerability, livelihood risk, and catastrophic loss. And when delivered effectively and inclusively, it helps building prosperity by facilitating trade, credit, and efficient economic activity, promoting effective risk management, and contributing to the development of the financial sector and its deepening by helping capital market, including the deployment of long-term capital in the real economy. So just to pick an example to set the scene, in fragile conflict and violence setting, it is often the most vulnerable, which are often the most vulnerable to disasters with very limited capacity to prepare and respond. So in this context, we help support countries to set up regional catastrophic risk pools, such as the Caribbean Catastrophic Risk Insurance Facility, known as CRIF. And this kind of initiative offers sustainable, country-owned regional solution and are supported by many donors. And it also has a direct impact on the country. So for instance, the CRIF payout to Haiti was the first external liquidity funding that the country received following the large 2010 earthquake. Same country, Haiti, received the largest CRIF payout to date following the Hurricane Matthew in 2016. So that's why it's so important, and that's why we are so committed to developing insurance in our client countries and not just disaster insurance. Now, what do we see in terms of state of the insurance market in developing countries? Most of them are very underdeveloped insurance market with low penetration rate. The market are usually focused on compulsory insurance, usually motor third-party liability insurance, as well as other non-life type of insurance. Life insurance itself is very underdeveloped. Normally, it's term insurance purchased by business for key persons. We also see that capacity building is needed to train supervisory staff properly, and there is also a lack of actuaries. So that's why we are very committed to support and facilitate the development of insurance market, and we think that's directly related to our twin goals of poverty reduction and shared prosperity. So I'm going to touch on 4 issues: stability and capital adequacy, climate risk, addressing the financing gap via private capital, including institutional investors such as insurance company, and finally, technology and financial inclusion. So, I mean, you know it much better than I do that there is a very strong link between insurance regulation and supervision and trust and confidence in the insurance sector, leading to increased insurance penetration. So a couple of numbers. In Sub-Saharan Africa, MENA, and South Asia, the insurance penetration is less than 2% of GDP. That compares to North America, 9.3%, or the worldwide rate average of 3.9% of GDP. In less developed markets, the role of insurance is also often overlooked. In East African countries, less than 10 in 100 people are estimated to have any form of insurance. The key risks that are relevant, or the key risks to the insurance market development that we see in developing countries are the following: mispricing and reserving risk, inflation risk, food inflation in particular, which leaves little disposable income to save or purchase any kind of non-compulsory insurance, climate risk, I will come back on that later on, and also poor corporate governance and insurance company and insurance authorities being led by individuals sometimes without an insurance background. And it's under this lens of underdeveloped insurance market and risk profile that we see big differences with developing economies. So the World Bank is working with countries to really strengthen their prudential framework for insurance regulation and supervision, focusing on risk-based approach. This is a way to have more appropriate measure of capital adequacy, greater confidence in the sector, and increasing penetration of insurance market while mobilizing what are sometimes scarce resources and capacity on the most fundamental issue. So a couple of examples of the kind of engagement that we have. In Albania, we have strengthened insurance regulation and supervision, at the same time as we're working with economic development over the last 2 decades, and that affected the insurance market in Albania, which grew twice as fast as the nominal GDP over that time period. In Tunisia, we are working with the regulators to implement IFRS 17, the development of market conduct supervision, transition to risk-based capital framework, and risk-based supervision. And in Bangladesh, we have worked on developing supervisory structure, capacity building of staff, enhancing governance policies, internal policies and control, strengthening the insurance market regulatory and supervisory framework, going from risk-based supervision to solvency, reporting, consumer protection, claims management, and on-site and off-site supervision. So that's the diversity of engagement, but also, as you can see, diversity of countries with which we are working. Now, climate. I mean, as you know, lower income households are disproportionately hit by climate change with fewer financial options to address and cope with impacts. So that's why we are focusing a lot on climate risk and financial protection. What we see is that the greatest driver of climate change-related poverty increase are related to loss of agricultural yield due to climate change, health impact, lost labor productivity due to increased temperature, and increase in the frequency and impact of natural disasters because of climate change. And at the same time, you see countries like Burundi, which only emits less than 0.20% of the world's greenhouse gas, and therefore very limited contribution to global warming. And at the same time, this is a country that is ranked 22nd in the most vulnerable to climate change in the world. So you have that disconnect between mitigation, adaptation, and really the need to prepare the countries. Burundi has also lost 5.2% of its land area every year to soil degradation since 2020. And since 2018, the World Bank has been supporting investment to build resilience in rural landscape. Now, looking forward, we think that climate change may put more than 130 million people into poverty over the next decade and cause more than 200 million people to migrate within their own country by 2050. This is why we are quite concerned about the possible exclusion of climate risk by insurers, as this would disproportionately impact the poorest and most vulnerable. One example, in the Philippines, if coastal risk was excluded, what impact would that have on market development and coverage? But let's not just look at the risk and the potential exclusion. There are also many opportunities in the insurance sector to respond to climate change. One is strengthening institutional responses, sustainability disclosure, financial stability analysis, and also the development of new financial service products, going from index-based agricultural insurance, which can provide a cushion during harvest season, or digital financial services to quickly send and receive domestic remittance or insurance product following hurricane or flood. So this is why new financial services are needed to help poor people build resilience, access to basic financial services like secure savings and remittance, and that continues to play a fundamental role in helping people around the globe respond effectively to climate-related shock. Now, as I mentioned earlier, the mobilization of institutional investors, including insurance companies, is really important to close the financing gap. By our estimate, through 2030, $2.4 trillion will be needed in public and private spending to address climate change, conflict, and pandemic in developing countries. So scaled finance from all sources is needed to meet the estimated additional 20 trillions needed in financing over the next decade to address development and climate challenges in developing countries. So why develop capital market? First, to better mobilize saving and private capital for investment, which will promote long-term finance, access to finance for public and private sectors, including SME, increase financial intermediation and enhance transparency, but also to build financial stability and resilience as a way to support fiscal and monetary policy implementation, having a well-functioning bond market, a well-developed base for local institutional investors, and all of that contributes to improve economic resilience and deeper and more efficient capital market. And finally, if there is a critical mass of domestic savings and institutional investors, these are preconditions and drivers for capital market development. So what we see is that the development of insurance in developing countries is also very important to build strong domestic investors and address those financing gap and crowding cross-border investment. And we see that insurers and pension plans can really play an important role in the development of domestic capital market. One example, in Vietnam, together with our colleague at the IAIS, the private sector arm of the World Bank Group, we supported work on the precondition for capital market development, and the beginning, which was starting in 2017, and this resulted in improving government bond market, in itself facilitating the development of corporate bond market and equity market, offering investment opportunities for institutional investors. And final point, technology and financial inclusion. This is really a big priority for us, as the access to affordable financial services is critical for poverty reduction and economic growth. Basic financial services, payment, credit, savings, insurance, help the poor and those excluded, in particular women and small businesses, to increase their income, better avail economic opportunities, and become more resilient. So there's been a lot of progress on financial inclusion, and according to the latest Findex data, which is the measurement put in place by the World Bank, the share of adults having used financial account rose by 30% between 2011 and 2021, climbing from 41 to 71%. There is still an important gender gap in account ownership, but it has fell from 9% per point to 6% in the last 4 years in developing countries. That's access. There's still an issue with usage and also a need to diversify the kind of financial services that are offered. And what we see is that in emerging markets, 80% of adults that save could more easily cope with emergencies. That's particularly relevant in the context of increased shock, in particular the climate change. So really that element of access to financial services and saving. So one of the lessons of the latest Findex is that fintech is really making a difference. So really leveraging on technology, and that's part of the rise of these digital financial services, mobile money being an important component. In less than 15 years, 1.3 billion registered mobile money accounts were created, with Sub-Saharan Africa leading the way. And that's where the intersection of financial inclusion and technology has also helped to move the needle and achieving important progress in countries like Nigeria, Kenya, and Uganda. So one example, M-Kopa, which is an asset financing platform, has enabled 2 million customers to access a diverse set of products, including smartphone, solar lighting, solar-powered appliances, and digital financial services such as cash loan and health insurance. So we see that the benefit of financial services, including digital financial services, are well documented, but there is also new risk related to fintech for both user and the broader financial system. So that's why we need to look more carefully at issues of abuse, digital fraud, peer-to-peer lending platform that may collapse, and borrower distress, which may be the result of irresponsible digital microcredit or lending practices. We also see that there might be additional barriers for the underserved because of the access to technology. So not everything will be solved, and there is also a need to look at consumer protection, financial literacy. But this is the part where there is a huge potential, and we think that the insurance sector could both contribute and benefit from pushing the envelope on technology and the transformation of finance, thanks to new technological development, both in terms of business model, new delivery, and new product, and facilitating access for those who are still excluded from the financial sector. And we very much hope we'll continue to work with you and the client countries so that we can make sure that the insurance sector grows and benefits from this development. So thank you very much, and I look forward to the discussion.
So good morning, everyone, and thanks very much, Clara, Ricardo, and Dana and Mike for having us all here. Thanks, Jean, for this great keynote speech. So I'd like to ask you a question. You did mention in the beginning of the issues the importance that you place on the development of risk-based solvency frameworks in the markets that you're trying to support. How actually are you going about supporting this development, and what are you actually doing?
So we think it's really important to work on risk-based supervision and risk-based capital framework, because this is also a way to adapt the international standard to the specific situation of emerging market. So when you look at the existing risk-based capital framework in advanced economy, they are quite complex for emerging market, and in particular because they are short of supply of insurance expert, actuaries, data, and deep and liquid capital market. So when we are asked, I mean, we intervene when we are asked by our client countries, part of the work is really to help them understand the specific risks in their markets, to build their capacity to think risk-based supervision and risk-based capital framework, and then implement and mobilize their resources much more efficiently. So two key advantages to that: it's a better way to respond to changing market and increasing range of risk. It also offers flexibility and responsiveness when managing emerging and complex risks. So usually our counterpart, our insurance supervisor, we work with them and the industry to make sure that there is that customization, terrorization, following obviously the principle and the requirement of the international standards, and helping them move towards this risk-based framework in a way that is really country-specific. So that's why we think that's useful. That's also a way to build confidence and trust and make sure that supervisory resources and the regulatory framework provides both the comfort and helps build the trust by the population, hoping to improve penetration.
Thank you very much, Jean. I mean, this is obviously a shared area of interest between the World Bank and the IAIS, because one of our goals, and we're discussing actually our strategic goals for the next 5 years, but within our current high-level goals, capacity building is a very important aspect of that, and as part of supporting supervisors to be able to supervise the markets and clearly create the trust that would then lead to greater financial inclusion and insurance market development. So we do that by actually working together with a number of implementing partners to provide this capacity building. And clearly this is an area where the IAIS and the World Bank can join up efforts. And indeed we are doing so already, but this is an area that we really have a common interest. So I'm glad to hear what she said. Separately, I mean, you set out some very striking statistics and actually examples about the projections that you have about the impact of climate risk. I mean, within that, within climate risk is, of course, the risk of natural catastrophes, which could or could not originate from climate change. And we have identified, and as you know, that there's a huge natural catastrophe protection gap that is even bigger in developing countries, given their low penetration, which you set out, which makes the whole thing, as you said with the Burundi example, even more striking, because it is so unfair. The jurisdictions that contribute the less to the problem could be often the ones that suffer the most. And clearly insurance and insurance supervision can be one of the ways to help address it. What examples of best practice are you observing in your work in these markets and economies in terms of trying to close or address these natural catastrophe protection banks?
So maybe let me, two elements. One is understand and assess the climate risk. So this is work that we started quite some time ago, but at the moment, very much with banking supervisors, so central bank as counterpart. And that has helped us begin to devise methodologies. And we are now beginning to receive requests from insurance supervisors on how to do that. So that's one part of the work which is more related, anticipating from a prudential standpoint. So let me start and quote an example, which is Nepal. So Nepal is a country that has exposure to climate variability, extreme event, And that has impact estimated between 1.5 and 2% of GDP annually, which is quite a challenge already and likely to become even more acute when climate risks increase. So what we've done is that we've worked with the Nepal Insurance Authority, the insurance industry and the reinsurance companies, but also brokers, agents, insurance journalists, actuaries, to really look at the landscape and work with them on the disclosure requirement of climate-related risks by insurance, reinsurance companies, addressing, assessing, and monitoring the risk, including the climate-related risk for insurance and reinsurance company in Nepal. And then we started work on disclosure, reporting. We are trying to improve the data and their data collection so that they can improve their risk assessment. And these are indeed, as you mentioned, areas on which we are very keen to work with IAIS, but also looking at what's coming in terms of global development. And one expected very soon is the sustainability reporting standard by ISSB and how to help the client countries do that. Now, that's part of the work. Another part of the work has been more related to closing the financial protection gap. So this is starting with disaster risk years ago at the back, and we've now extended that to climate risk, in particular physical risk. And then part of it is really to help countries having comprehensive strategy, better understand the risk, better prepare, so the financial protection at different levels, the sovereign term, what products can be offered, as well as household. And that's the example that I mentioned earlier. In Haiti is part of that work with many client countries at the regional and country level. And we are part in that context of an initiative that was launched at COP27 called the Global Shield, where the focus is really in interested countries and target countries to help them design that overall financial protection and mobilize resources so that they can cover the gap, but also mobilize private capital to improve their insurance coverage and reduce the cost on the budget.
Thanks very much. And that's, again, another area which, again, for us, from a supervision perspective, I mean, clearly we share our particular goals, our fair and stable insurance market and the protection of consumers and policyholders. But there's an alignment in what you want to do and what we want to do in these particular economies. I mean, we are going to be publishing a paper about what supervisors can do to help in the area of natural catastrophe protection gaps. I mean, one issue actually that we do face is the different supervisors have different mandates in terms of market development. But it is an issue that could potentially even have financial stability or broader, well, it will have broader macroeconomic, it already has broader macroeconomic consequences, as you mentioned, with Nepal. And therefore, it should enter the mandate through that route. So that is, again, we're going to be sort of publishing this paper, and the G7, which of course have endorsed Global Shield, also have written in the written communique that they look forward to this particular report. So again, an area where we should be connecting. I'm conscious of the time, so I'll ask one more question before we wrap up. And I'm also conscious of the fact that it's an evening in Dubai, and I'm sure you're looking forward to getting some sleep. You mentioned very much the issues around capacity building, lack of actuaries, etc., as one of the factors that are inhibiting the development of insurance markets. And obviously there's capacity building that relates to the insurance supervisory and regulatory authorities as well, which also need actuaries and expertise. What practical support are you offering to insurance supervisors across the world that could be of interest to our audience?
So part of it is to help with the capacity of the supervisors, but also make sure that whatever capacity they have is deployed on the most important issue and in the most effective way. So that's where there is also that link with risk-based approach, risk-based capital requirement, risk-based supervision, so that in addition to building the capacity, and I'll come on that in 1 second, part of it is also helping our client countries make sure that they align their systems as much as possible to the risk. So what we do when it comes to capacity building, so it's very customized. It depends a lot on the needs of the client country. So in some cases, it's support to bring their regulatory supervisory guidance framework to the best practices adapted to their system. In other cases, as we just discussed in the context of climate risk, is helping better understand the risk and then make sure that both the regulation and supervision, as well as their effort on market development, are more focused and addressing the key issues. It can go to things that are very practical, such as knowledge exchange with other countries so that there is peer learning and facilitating all these kind of elements. In other cases, it's more about market development and market structure. What may be the key obstacles that exist in a given jurisdiction to open the market, make sure you do it in a way that is responsible and making sure that that there is no abuse of the market, etc. So we try to cover a range of issues. We don't have so many people working in the insurance sector and the board, so we are trying to be very selective, but I think the main message is one, having the global reference and the international standards. Second, bringing as much experience and expertise from other countries' situations, so a lot of peer learning, and then adapting our support to the specific need of the jurisdiction. And also mobilizing our network, including IAIS. So we don't do everything in-house, but really bring the experts, including colleagues in other countries and IAIS, so that we can bring the best expertise and input and frameworks to our client countries.
Thanks very much, Jean, and thanks for giving this fascinating talk and from joining us in this global seminar. We look forward in strengthening our links because of our aligned interests in order to deliver more resilient insurance markets. And in the developing economies, it will have the very important socially also consequence that is in your goals of reducing poverty and sharing prosperity. So thank you very much for that. A big round of applause for Jean.